You ever see a stock with a huge dividend yield and just think, is this for real? Is it too good to be true? Well, today we're going to drop the blueprint for a safe dividend. We're going to show you exactly how to tell if a company's payout is a solid foundation for your money or if it's just a ticking time bomb. Okay, let's get into it.
Take a look at this number, 9%. In late 2023, this was the dividend yield you could get from a company we all know, Walgreens. I mean, a nearly 9% return just for owning the stock? That's the kind of thing that gets your attention, right? But a number like this should also set off a little alarm bell. So what is it? Is this a genuine gold mine, a reward for spotting an amazing deal that everyone else missed? Or is it a classic high-yield trap, a huge warning sign that the whole thing is about to come crashing down? How in the world are you supposed to know the difference? Well, turns out there's a tool for that.
So how do you spot that trap before you step in it? The pros use this really powerful metric called the dividend payout ratio. Let's break down exactly what that is. The dividend payout ratio, or DPR for short, basically tells you what slice of a company's profit is being handed over to you, the shareholder. See, unlike the dividend yield, which just compares the dividend to the stock price, the payout ratio gives you a real look under the hood at the company's financial health. A high ratio can be a red flag, for sure, but to really get the full picture, we've got to go one level deeper.
Here's the thing, a company's reported profit, it isn't the whole story, not even close. To really figure out if a dividend is safe, you have to follow the cash. Because at the end of the day, companies don't pay their dividends with accounting theory. They pay them with cold, hard cash.
And this chart shows that difference perfectly. You've got net income on one side. That's the theory. It's an accounting number. It includes all sorts of non-cash stuff and spreads big costs out over many years. But then you have free cash flow. That's the reality. It is the actual spendable cash the business has left over after paying all its operating bills and investing in itself.
Here's a super simple way to think about it. Net income is like the total amount in your paycheck before taxes and everything else comes out. But free cash flow, that's what's actually left in your bank account after you've paid your mortgage, your car payment, and bought groceries. You can only spend what's in the bank, right? Well, it's the exact same for a company trying to pay a dividend.
And this is the absolute crucial point. A company can look totally fine if you only look at its net income payout ratio. But when you check its free cash flow, you might discover it's actually borrowing money just to send you that dividend check. So the free cash flow payout ratio, that is the ultimate reality check.
Okay, so we know we need a payout ratio that's sustainable. But what does that actually mean? Like, what's the perfect number to look for? Well, a huge landmark study gives us a pretty specific answer. Now, this is where it gets really fascinating. This study from Wellington and Hartford looked at dividend stocks for almost a century. And you would think the stocks paying out the absolute most money would be the best ones to own, right? Nope. It was actually the second group, companies with moderate but not crazy high payouts that consistently beat the overall market. And that brings us to the magic number, that sweet spot. The average for that group that kept outperforming was a payout ratio of around 40%. And it makes perfect sense when you think about it. A 40% ratio gives shareholders a nice income stream, but it leaves the company with the other 60% of its cash to reinvest in growth, which builds a safety cushion and fuels bigger dividends down the road. All right, theory is great and all, but let's see how this stuff actually plays out in the real world. We're going to look at two very famous dividend stocks, one that handled things perfectly and another that walked right into the trap. So first up, we've got the industrial giant 3M. This company was a dividend king, which means it had raised its dividend for over 60 years in a row, an incredible streak. But in 2024, they ran into a perfect storm of trouble and had to make a really tough call. So the company was staring down the barrel of billions in legal costs, and on top of that, it had just spun off its healthcare business, which was a huge cash cow for them. Management looked at the numbers and saw the writing on the wall. There was no way they could afford the old dividend. So they made the smart, strategic move. They ripped the Band-Aid off, cut the dividend, and specifically targeted that historical sweet spot of 40% payout ratio based on their new, lower cash flow. And you know what? The market actually applauded them for it. Now, let's look at our cautionary tale. Walgreens, another dividend aristocrat, this one with a nearly 50-year streak of dividend hikes. But unlike 3M, they chose to just ignore the flashing red lights from their payout ratio. This number is it's wild. Before they finally had to cut their dividend, Walgreens' payout ratio had swelled to almost 291%. Let me put that another way. For every single dollar the company was earning, it was paying out almost $3 in dividends. This wasn't just a red flag. This was a 5-alarm fire.
And that is the huge lesson from Walgreens.
A company's impressive history doesn't matter one bit when the math stops working. When the payout ratio gets completely disconnected from the reality of how much cash is coming in the door, a dividend cut isn't just a risk, it's an absolute certainty.
Okay, so how can you take all of this and apply it to your own stocks? Let's put it all together into a simple 4-point safety checklist you can use to stress test any dividend company. First, check that payout ratio and make sure you're using free cash flow. Is it under 60%? That's a good starting point. Second, look at the balance sheet. Too much debt is a killer because those lenders always get paid before you do. Third, check the cash flow coverage. Is there enough cash coming in to easily pay the dividend and still have some left over? You want to see a nice cushion, say at least 20%. And finally, look at the business itself. Does this company have something special, what Warren Buffett calls an economic moat, that protects it from competitors and keeps that cash flowing for years?
So now you have the architecture of a safe dividend. You have the blueprint. So the real question is for you, go and take a look at the stocks you own. Which ones are the prudent, strategic 3Ms preparing for the future, and which ones are the ticking time bombs just hoping you won't notice the math doesn't add up anymore?